Hello, I am Ian Miles, Head of Tax at James Cooper Preston, and welcome to today's Tax in 10 topic, which is pre-5th of April tax planning for individuals. There are a number of planning opportunities available to taxpayers to help manage their tax affairs that can and should be considered before the 5th of April each tax year. These are not controversial schemes and are opportunities that are available through normal planning channels. There are investment opportunities such as ISA investments, where every individual can invest up to £20,000 each year into an ISA. And my suggestion is not to leave it until the last minute, or you may find that it's too late to make the investment and get your money in. For those with deeper pockets, it's possible to invest up to £1 million annually into EIS companies and obtain 30% income tax relief. Whilst I say £1 million is the maximum, there is no minimum that must be invested. But this is also an efficient way of deferring paying capital gains tax, and the gain on the EIS investment itself is free of capital gains tax if it's held for a minimum period of 3 years. There are specific rules for the investment periods and how the income tax relief is claimed, as well as how any losses on these shares can be utilised against other income or gains. Seed EIS is similar, but the maximum amount that can be invested there is £100,000 and the relief is 50%. In addition, there may be opportunities to invest in venture capital trusts and so on. Those who are employed by companies may be able to influence the timing of the payment of a bonus. If the bonus is paid on the 5th of April, then the tax will be due in that year, whereas if the bonus is paid a day later, then the tax will be due in the following year. That may give a cash flow advantage, or more likely a tax rate advantage, perhaps depending on how the tax is collected. Those who are employed by companies that they own will have the choice of being paid by salary, dividend, or a mixture of both. The rate of tax on dividends is lower than on salary, and there's a £2,000 dividend allowance. Tax is paid at 7.5% for dividends falling in the basic rate band, 32.5% for dividends falling in the higher rate band, and 38.1% for dividends falling in the additional rate band. But dividends form the top slice of income. Salary, on the other hand, is taxed at 20% in the basic rate band, 40% in the higher rate band, and 45% in the additional rate band. So you can see there's quite a difference in the tax rates. But for the employing company, there's also employer-related national insurance contributions at 13.8% on salary, and employee contributions at 12% above the NI threshold, and then at 2% above an annual equivalent salary of just over £50,000. Salary counts towards relevant earnings for making pension contributions, whereas dividends do not, and that may influence people's choice of how to take their remuneration. Everyone can make a contribution of up to £3,600 gross towards their pension, irrespective of their income, or up to the level of their relevant earnings, subject to a maximum pension contribution of £40,000 gross of the basic rate of tax. The £40,000 cap is tapered when adjusted income, which is income including employer pension provisions where they're made, where that's over £150,000. And the taper is such that the £40,000 maximum is reduced by £1 for every £2 of adjusted income over £150,000, subject to a minimum pension contribution of £10,000 gross. Thus, when the adjusted income is greater than £210,000, the minimum annual pension contribution is still £10,000 gross. An important point to remember is that unused allowances can be carried forward for 3 years. So it's important to see if there are any unused pension contributions that will go out of date after the 5th of April annually, and either use them or be conscious that they're going out of date. Gift aid can also be used successfully in tax planning, though perhaps it's not so important to make it in the tax year, as a gift to charity made after the 5th of April can be related back to the previous year. For more information on that one, please see the self-assessment podcast. One area of planning may be to try and equalise income between spouses, so that both are utilising their basic rate bands and there is not one spouse paying tax at additional rates while the other spouse has not used their personal allowance. That won't always be possible to achieve, but it is worth looking at to see what options there are. Capital gains is another area that is worth looking at. The capital gains annual exemption for the year ended 5th of April 2020 is £12,000. This means that if an individual makes net gains, i.e. capital gains less capital losses, of up to £12,000 in that year, then they do not have capital gains tax to pay. If losses are made, then the capital loss can be carried forward without time limit to set against future capital gains. If possible, it's usually considered more efficient to make losses in an earlier year and then set them against gains of a later year. Please remember that it's possible to transfer assets between spouses on a no gain, no loss basis, or to own assets between the two spouses if that helps to mitigate the capital gains tax by using both annual exemptions. Capital gains tax is not like income tax, so insofar as income tax can give rise to payments on account, again please see the self-assessment podcast, capital gains tax does not. The due date for the payment of capital gains tax is the 31st of January following the end of the tax year. So deferring a gain from the 5th of April to the 6th of April will defer the payment of tax by 1 year. One specific counter to that is the present main residence relief exempts most people's homes from capital gains tax. This is not always the case, and where a home doesn't qualify for relief in full, if the house was ever the owner's main residence and qualifies in part, then the last 18 months automatically qualify for the relief, even if the house was unoccupied. This time limit is being reduced to 9 months from the 6th of April 2020. So, if there is to be a restriction on the main residence relief for those last 18 months, then accelerating a gain such that the sale is made or exchange of contracts are made by the 5th of April 2020 may be beneficial. Similarly, the lettings relief is being restricted from the 6th of April 2020 onwards, so if lettings relief applies to reduce your capital gain, it may be beneficial again to advance a sale. The last area that I want to consider is inheritance tax. Every individual can make gifts of up to £250 each tax year to any individual, and that's designed to cover annual presents such as birthdays and Christmas. In addition, each individual can make annual gifts in total of up to £3,000, though that can't be used in conjunction with the £250 small gifts exemption. If the £3,000 is unused from the previous year, then it can be carried forward for 1 year only and is used in the later year once the £3,000 annual exemption for that year has been used. I think that those are the main points that I wanted to make. It's not an exhaustive list, so please come back to talk to us. The first meeting is free, or to speak with your existing advisor if you have one. Thank you for listening, and please send us any feedback. Thank you.